Does growth trump inflation? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Cem Karsan, founder of Kai Volatility. Hey, it's great to have you back on the show.
Hey, Maggie. Good to be back. How have you been?
Oh, it has been a week since the election. And
you mean a year?
A year.
The last week feels like a year.
Yeah, because we've just had things flying, right? Trying to keep up with it. We have crypto storming higher. Bitcoin's up 10% just today. Just today on the day. Stocks higher, dollar higher. Bonds are closed today. So that's one thing we didn't have to watch for Veterans Day holiday here in the US. But there's been a lot of attention on yields. Just big picture, just want to get your thoughts on the response that we've seen in the markets following the election.
Yeah, I mean, what you'd expect, what we've talked about. You have a resolution of the unknown, the fears, which were overblown, of some type of contested election, something that, and the record volatility of the event and skew from that event, paired with historic structured product positioning, et cetera, resolves to the upside, right? This is, again, interpreted by many as Trump won, so the market rallies. It's a lot more structural than that.
Oh, that's so interesting. That's just interesting in of itself, because I certainly looked at the response and thought, oh, there's this, all this enthusiasm and optimism, which I think there's a lot out there if you read the comments and a lot of the chat on Substack and notes and everything else I'm seeing. But you're kind of pointing out that this is the fact that we didn't get that calamitous contested. Yeah.
That's the overwhelming, the internal rotation stuff we can talk about otherwise. But the actual market beta, I encourage people to think about 2020 and then to think about 2016. And under both conditions, people on one side were saying, oh no, if so-and-so wins, the market is going to collapse, right? And under both conditions, what happened? The market rallied hard under both conditions, whether it was Biden or Trump. And we could argue that they're dramatically different or blah, blah, blah. Not so much. The big trend is, and again, I've said this again and again, now the path and the speed of which things happen will, and what specific details underneath the hood take over during certain time periods will be tied to a certain candidate. But for the most part, these candidates, both of them, are symptoms. They're not the cause of a much bigger thing, which is populism. And the path continues, in one direction, regardless of who is leading the charge here. Now, that said, there will be underlying differences in path along the way to get there. From 68 to 82, we've talked about this. Like you had Republicans, you had Democrats, you had all kinds of different candidates come, through the pipe. The result was the same. You might have gone down and then up and then up and then down, but the reality was the secular trend was the same, and that's really what matters here. After an election and event vol, especially going into the end of the year with all of the size of the position that there was, a resolution means quite simply skew comes off the table, deltas get bought back, and the market already up has a rebuying effect. We've been talking about this, this is about to happen for 3 months, and we told you the timeline of which it would happen. We're not lucky. We don't just keep getting lucky. These things are dominant in the short term.
Yeah.
Now, there will be some underlying dispersion of performance as a function of slightly different policy and the speed of implementation of that populist policy, which we can dive into. But
I'm laughing so hard. Hey, everybody in the chat. First of all, Christopher just pointing out that you absolutely did predict pretty much in lockstep what was going to happen here. And for those of you who may be joining for the first time, generally looks at, has a sort of real, I think, understanding of what happens in all the flows and options and derivatives markets that really impact things in a way that maybe the headlines, don't sort of mask, or they attribute it to something, but what's really going on is all the flow of this really important money. And Daniel Miller just said, Cem, can you explain the real reason the Santa Claus effect happens? And if you could explain this in crayon, that would be much appreciated. You don't know that we talk offline. Cem and I talk offline about doing this in cartoon style. Honestly, like we have had this conversation and laughed about it because it's what we all need. But because it's a good question, Daniel, because we've got the rally we've seen has because of the resolution and some of the unwinds that people had put on. Do we pick right up and move into a Santa Claus rally that happens typically this time of year, or have we pulled forward some of those gains?
So it's not always going to be a straight line, but there are some important effects to understand. Some of this is being pulled forward. That doesn't mean the rally doesn't continue. It just, the speed may be slower now. If you look at the flows that we've been talking about and what's going to drive the end of the year, beginning of the year rally, it's a function of massive open interest in put options and short interest in call options. So the combination of the two. Starting from the election and running all the way till January expiration. The epicenter of that is December 20th, the AM print of the monthly OPEX, and December 31st, end of the year. Those positionings are not only massive in terms of open interest, but the pricing on them is very high, which means they have a lot of potential energy. That is the risk that is being warehoused by the market. Banks, market makers, hedge funds, entities that are essentially doing this massive carry trade. And that those carry trades have to be, they force certain pressures in buying as that positioning comes off the table and becomes profitable. So that's one. Two, we have a massive releveraging effect. So as markets go up, we create a massive amount of new collateral. So if you have an asset that goes from $1 to $2, all of a sudden you have $2 to invest, not $1 to invest. Now that if you thought it went from 1 to 2, most people think, well, I already am invested at 2, not 1. Well, but if you have leverage on that investment, right? If you had 4 $1 and you and 3 of them were leveraged and 1 was real, and you went to 8, right? All of a sudden that collateral, right, which went from 4 to 5, now has to be reinvested, right? And so that releveraging, the majority of money in the market, not in the market, in the world, is debt. It's not actual printed dollars. When the Fed lowers interest rates, we talk about them increasing money supply. Why do we say that? Because they're increasing the amount of money by issuing more debt. And so at the end of the day, when the value of collateral or assets themselves go up, the amount of leverage that needs to be redeployed on that on accounts is significant. So in the case of the S&P 500, $50 trillion. In the case of global assets, 100 trillion. Global stocks, 100 trillion. Things tied to it, 200 trillion. We've talked about these numbers before. Markets up 20%, $40 trillion of new collateral. Well, okay, that amount needs to be reinvested. Now, it doesn't all go in Jan 1, right? A lot of it's already been reinvested. Some of it monthly, some of it daily, some of it monthly, some of it quarterly, but some amount of it. And particularly because a lot of this rallying is now happening into this last part of the year, needs to get reinvested at the beginning of the year. And how much, again, very hard to say. Is that 10% of that? That's probably a good estimate if I had to wave my hands at it. That's $4 trillion in the average amount. That's right. That moves so these markets. These are numbers.
These are big these are big numbers and big flows, which explains why they can have an impact, and that this is really what's going on, as opposed to, say, one print of an earning or one CPI number or something like that.
And regardless of who got elected, these flows are coming.
Yeah.
So to
Great.
kind of sit there and be like, well, it's going up because so-and-so is getting elected. Like, no, that's not the case. These flows are coming and they're here now. The resolution of not having a tail event like a contested election is forcing them to happen sooner and more quickly. And the fact that there was fear of that and there was more potential energy creates more of it. But these are kind of the biggest tenets. The other part is Thanksgiving, Christmas. We've talked about this before.
Yeah, shortened.
A lot of holidays. The decay of all of this positioning accelerates. And not just because of the holidays themselves, but the time around the holidays when people are not kind of in the market. Today is Veterans Day. Nothing going on. Banks are closed. Well, a little bit of acceleration. So what did we see this morning? A little bit of that buyback. You can see in the charts. In the morning what happens? Whoop, and then kind of fades a little bit, right? Because the buyback in the morning's gone, right? So these are the flows that underpin the market. The market knew it was coming. The second the resolution happened, it pushed the market higher. Now people who were not in are trying to get back in, and there's a bid underneath the market. This thing is not going to come back in any meaningful way before it runs more. That said, it is overbought. We got to almost the 3 standard deviation up above the 1 month, the 20-day moving average. That's 3 standard deviations is a big move. And so, yeah, guess what? It's digesting today. And it will continue to digest until it can take another run. When will it take a run? Well, the next place we have more of those flows, and the next time we have a bit of an acceleration of that time and the reduction in that vol. But because it's becoming so predictable now that the election is passed, that means vol compression is more likely. There's more longs in the market, people adding longs, and that's going to make it hard for it to run a lot quicker from here for a little bit of time.
So I have a very specific question from Christopher, and I'm going to get these in because this is why folks roll up live, and I think it's great to get the opportunity to ask somebody who's an expert in something. So Christopher is saying, is the market going to run over the JP Morgan year-end SPX collar at 60.55?
I think way too much is put into the JP Morgan collar and the importance of it. I'm not saying it's not important or that it doesn't have any relevance. But remember, the numbers, to equate the numbers we're talking about, that is a $20 billion fund. 20 billion. Now, the average amount of daily flows that move the market, probably about 75 billion on a daily basis. And then we're talking about flows into the end of the year, right? That amount to maybe about 4 trillion. So like, this is not the thing that you should be focused on. It matters on a daily basis, wherever that positioning is. It can have some gravity effect, but I think broadly, a lot of the entities that are selling you gamma models and telling you this is the tipping point based on the open interest are missing kind of the bigger picture, which is both those re-leveraging effects and the $1 trillion of structured product issuance that's going on behind the scenes that you're not seeing hit the markets.
So in our conversation, and I'm sure we're going to get a question on that. We'll talk about that in a second. In our conversations over the last year, you have been talking about populism. You've been consistent about this heading into the election, kind of, again, irregardless of who was running, because as we know, there was a change in candidates, and it doesn't matter. You've been very consistent on this. Given that there was such an overwhelming win for Trump, and it's not contested, what changes do you see coming? Because there's this short term we're talking about right now, which is going to get us through to year end and into January, which you've been very specific about. Again, people can go back to past interviews too about watching that for flows. What other changes are you watching for that we need to think about? And maybe it's in a slightly bigger time frame, because time frame's important when we're talking.
Very important. Yeah, time frame is very important.
What are you looking for as now? He'll be sworn in. We're already going to get an idea of some stuff because he's making appointments. I mean, does it matter? Again, like, do the specifics in the personnel matter, or how are you thinking about this?
It matters, right? I'm not saying that it doesn't matter, but fundamentals and macro outcomes matter over the course of years. not weeks or months.
Right.
Some analysis would say that, if you look at like research, most research says fundamentals don't matter on any period less than a decade. Like they're not predictive on any period less than a decade. Now, I think different when you're in these types of environments, and big macro changes can cause massive rotations, changes in the dollar, changes in interest rates very quickly. Those things can really, really drive big changes. So those are different kinds of fundamentals, in my opinion. So those are the things that I think you have to be focused on, right? The value of the US dollar is a huge deal. In the words of Donald Trump's, huge deal. An America First policy, by definition, means you are going to favor the American people over the people of the world, and in theory, corporations, right? Now, we'll see if he's going to be true to that, right? Again, he had that rhetoric last time around, then did massive corporate tax cuts. So, you got to take it with a grain of salt. But if he is truly, truly going to put up tariffs, and if he truly, truly is going to put up tighter immigration policy, he may not be. He's highly unlikely to actually export all of the immigrants that are here across the, as he said. But he is likely to close the border and try and, there's a huge political push to really to really stem immigration. If he's going to do that, to be clear, labor inflation, services inflation, let's call it, right, is still at 5.3% growth a year. People looking at inflation be like, inflation's fine. Services inflation is still running at 5.3% a year. Housing inflation is running at 4.2% a year. Currently, as it stands, without a tighter immigration policy, without tariffs, what's balancing in that is goods inflation is negative 0.9, right? And why is that? What's the difference between those two different inflations? Why would we have such dramatically different inflation? By the way, this is not a one quarter thing. This is structural. If you look at it year over year, quarter over quarter, it's consistent. Why is that? Pretty simple, right? One or two of them, housing and service, are internal inflation. Goods, which is what we're importing from abroad mostly, is external inflation, right? And the internal inflation is the world that is here, that is this closed world that we live in this populist world where we're starting to, having limited labor supply and running a different kind of fiscal policy here internally, right? We have a real shortage of labor and a real shortage of housing. Mm-hmm. And we can't import those. We can't import housing, and we can't import people. Or can we? Well, we've tried, okay? So we've tried to import people. That's what immigration policy is. Incredibly unpopular in a populist environment. But if you step back, right, if we're going to put a wall up against to China, and people in the U.S. aren't willing to take those jobs at those prices, right? How are we going to keep that labor inflation at bay? And how the last administration has done it is by allowing more immigration. That's what's happening. It's unpopular. But if we put a top on that, what do you think happens to service inflation? What do you think happens to housing inflation? Right?
Yeah. And we all know, if you look around in those industries, like we see the impact of immigration because it's likely you've interacted with somebody who's building a house or serving you at a restaurant that are new to the country. So I think this is so interesting. So let's flip that and get to the heart of what a lot of people say right now. And I know you've heard this. Anybody who watched your interview with Rick Santelli knows this. So they'll say, okay, but that's good. That's what we voted for. We want to give the American worker who's been, crapped on and gone nowhere. We want to give them a working wage, and we want to see them thrive and do well. That's populism, and that's good. We want that. We all voted for that, which is fine. So I guess the question is, and which is great, and a lot of people agree with that. So there's a price to that, though, right? Exactly. And so can we grow enough? If the worker does well and wages are up, can that growth and the economy's firing on all cylinders be enough to offset the inflation? Or can we live in a higher inflationary environment if all these good things are happening?
It is good for median outcomes. It is not good for mean outcomes. It's that simple. If you run a free market economic system, it's more efficient. You can allocate labor at cheaper costs and produce more goods, and profits for companies go up, and we have technological innovation, and growth accelerates globally. If you prioritize median incomes within a country, we close the system and it becomes dramatically more inefficient. That's okay. I'm not painting this as a negative. Median people here in the US will probably do better. Probably not a lot better, to be clear, but they'll do better. But the total outcome of the country and growth and definitely corporate profitability will be in the gutter. So again, we have to choose what's important. We prioritized mean outcomes in GDP, right, for 40 years. And what that led to is massive inequality.
Mm-hmm.
And when I say we chose that, that's the natural state of things. In the absence of choosing something else, that's what happens. That's the way of the world, right? Life isn't fair, survival of the fittest, absolute power corrupts absolutely. Choose your cliche, right? That is the reality of the world. Powerful and corporations will become more powerful and more profitable in the context of a world where we don't prioritize workers.
Yeah. So let me ask you about where those costs show up. And I'm also not asking this from a partisan point of view at all.
Either am I.
But right
to be clear,
now,
this is
right.
not a partisan
No,
commentary.
just a disclaimer out there for all who think that we've got an ulterior motive at this. But I'm seeing this change coming, if you're right, and everything doing well now because of the flows we talked about. But at some point, that may not be the case. So where does it show up so we can position ourselves? So let's start with the stock market. In that kind of environment, it sounds like it's negative for earnings and problematic across the board, or is this a place where we saw the Russell take off after right after the election? So is this an environment where some companies benefit based on how they're situated?
Absolutely. It's an incredible opportunity. You see, it becomes less about beta one and it becomes more about rotation. Mm-hmm. Certain companies do very, very well in this type of an environment. Now, it's not the ones that have been doing well. And on a market cap basis, it's going to be very poor for equities writ large, particularly in real terms, if we have an inflationary period. But there are some sectors in some areas that will do incredibly well in an inflationary period. I'll highlight one that seems pretty obvious: commodities. Why do commodities do so well during this period? Well, again, they hold their value in an inflationary environment. There's more demand. We're pushing a demand push economy. I think that's the way people need to think about this. It is a demand push economy. We've been running a supply push economy, right? We've been sending money. I used to call it Planet Palo Alto. That was the term. We've been sending money to Planet Palo Alto, and they've been creating incredible new technologies and incredible supply and shipping it back at warp speed to our world for 40 years. That is how stimulus has been working for 40 years. Stimulus is now not working that way. Stimulus is running to the people of our planet, and that is creating massive demand. But we are taking money away from Planet Palo Alto. And Planet Palo Alto can no longer create supply like it used to. And now there's more demand than there's ever been. Okay. So the net result, which was structurally deflationary for years, right, is being flipped on its head. And so the question is what types of things make money when we are no longer sending money to Planet Palo Alto and we're sending money to the people of the planet to consume? And it's a completely different type of stimulus. People say stimulus, monetary, fiscal, and everybody's like, oh, that's inflationary. It's not all inflationary. One of them, they're short-term inflationary. You put a bunch of money in, you get a little pop, right? Regardless of where it goes, differing degrees. But if you send money straight to people, that has what economists have made a term, which I think is pretty ridiculous, called the velocity of money. The velocity of money, if you send it to people, is 1, right? You could say it has even more than 1 if they're in certain type of areas like education or or infrastructure, but has a velocity of 1. If you send it to supply, it has a velocity of like 0.1, almost 0. And you could argue in the long term negative, right? That's the difference between sending it to supply versus demand, almost polar opposite. So what type of things do well? You may have seen me shuffling papers while I was kind of talking to you. Well, I happen to have a list of things that do.
I had a feeling you were going in the grab bag for a list.
Yeah. And we do this on our wealth advisory side for our thematic equities. Government spending is at the center, right? The free market economics does not redistribute money to the middle class or the poor. It doesn't. You need it, and this is kind of the role of government, right? And during populist periods, by definition, you have bigger government, more spending, more activity of fiscal spending. So go to the mouth of the fountain. Where's the money coming from? Look at the budget of the US government. Just go down the list. Those are things that will do quite well. Healthcare, infrastructure, transportation, agriculture, energy, education, housing and urban development, utilities.
But don't we have sort of Elon and Trump who want to get rid of half the government? Like, does it feel like it's going to be different this time?
You're going to get rid of half the government and be populist? Explain to me how that works, right? I mean, sure, if they do that, that's not populist, and I'm guessing that people will be worse off, and then they'll get kicked out of office in 4 years. It's possible in the short term, right? But if they're truly going to respond, I mean, again, Donald Trump is a genius marketer, right? Like that's what he's built his brand on and what he's done. He sees what people want and he goes and he sells it to them, right? Yeah. He's selling populism because people want it. He's trying to give the people what they want. Now, the question is he going to give it to them or not? That's a separate question.
So let's go through your list because you're going to kill me. I interrupted you. Healthcare.
Yep. Which again is not something a lot of people are talking about, right?
Nobody.
Infrastructure. People are talking about infrastructure. Energy. People are talking about energy. But transportation, probably something people don't think too much about, right? Other than somebody who was way early to that game, which was Warren Buffett, right? Housing and urban development. Utilities. That's interesting, right? We've seen an incredible run on utilities, and people are scratching their head over it. I thought that was a defensive sector. Not so defensive in a populist environment. And maybe the most important of all, national defense. National defense benefits from not just government spending, one of the biggest items of the budget, right? But it also benefits from global conflict and the increase of that. Why is global conflict likely to continue? Why are we likely to see these issues? Well, when we talk about populism, we're talking about our people. When we're talking about Planet Palo Alto, that goes to everybody. That's not favoring our country or our people. And again, we talked about this 4 years ago. We've been talking about this. Mm-hmm. We're just going down this path. This is clearly continuing. This is not something that changes overnight. If we continue to put up tariffs, if we continue to put up boundaries and favor our people, well, guess what? Other countries don't like that so much. Mm-hmm. Shocking. That may seem novel to people, but other countries aren't going to like that. So guess what? They're going to say, hey, wait a second. We don't agree. We want to do X. And so China and the US are increasingly adversarial. Number one and number two economies of the world used to be connected and growing together, now are bifurcated. That's going to increasingly happen. And you better believe that's going to continue to lead to global conflict. If you think the war in Russia, Ukraine, and the war in Iran, Israel, is a contained, isolated incident, and they're tied to some crazy leader or no. China is funding all of that. They are connected to the whole picture, and you better believe the China-Taiwan thing will be connected at some point as well. It is a global conflict. We're in a world war driven by protectionism and the desire for territorial strength and competition. We have gone from a cooperative environment to a competitive environment. environment, and that is not going away in 1 or 2 years or 5 years, maybe in 15, 20 years. All right. So if that's the case, national defense might be somewhere you want to invest. Nearshoring, onshoring might be something you may want to look at. Right. So commodities, we already talked about, they have an added benefit as well, right? Not only do they hold their value, but commodities during periods of populism, countries use them as core inputs, as a core area of strength, right? We saw in the 1970s, another populist period, not just global conflict, the Vietnam War, all the other things, right? We saw actually an OPEC crisis. That's not a coincidence. Commodities are a bludgeon. They're a way to compete and to show your strength over another country. So this time around, the U.S. has its own commodities, so OPEC is likely to be a little bit less of an issue, but you better believe there's a lot of other commodities out there, industrial commodities that there are shortages and they're concentrated in certain countries. And those in particular should be an area of focus. If there's limited supply that's controlled by certain countries, think about, rare earths, uranium and nuclear. If we're going to have nuclear demand, that doesn't come from every country in the world. Those things will do quite well. Things like gold and Bitcoin hold their value. Those things, again, we've been talking about, we've been buying gold since kind of it bottomed out in 22. And the way to do that is with convexity, with calls. Same with Bitcoin. It's a similar issue. And I won't dive into my whole Bitcoin thesis. I know you guys talk a lot about it. It's in my mind, it is millennial on down gold. And it will continue to have that benefit in an inflationary environment.
It certainly seems a lot of people have sort of, embraced that idea now with some of the regulation overhang. Hasn't happened yet, but the anticipation that, people do feel it feels a little bit different right now with this change in administration. Let me ask you, I just had a conversation with Michael Howell, who brought up such an interesting point, and he tracks liquidity sort of different, in a different way than you do. But I feel like you both really look at flows. And we saw bond markets closed today, but we saw this march higher in yields. It's been relatively well behaved, sure, given historical context, it still looks pretty low. But a lot of people are starting to get concerned about that. And if we get a true populist impulse and fiscal spending is through the roof, there's concern that authorities will lose control of the bond market, and we could see this spike in yields in a way that we haven't. We know we've seen that before in history in the period you're talking about, but back then people were used to higher interest rates. We've just gone through a decade where some people haven't even been born when there's been anything but zero interest rates. Does that worry you? How are you thinking about yields here, and could that curtail some of what happens in Washington?
Yes, but these things don't go in a straight line. People have to lose faith that it's working, and so again, fundamentals matter. In the short term, it's supply and demand, and so yes, we are going to continue to see a steepener. We've been talking about this for some time when the curve was significantly the other way, right? And guess what? That's been an incredible trade. It doesn't go in a straight line, right? The natural supply and demand would cause, as you bring down the front of the curve, spreads, which are traded actively and hold everything together, force everything down. But then that populism and inflationary structural effects push the back up, which is what we've seen. So this is kind of how the trade works. It's not going to be a straight line. My view is that we will hit 6% in the 10-year next year. And when we do, that will be part of the driver of why this market starts having major issues. Now, again, not a straight line. We'll see the route that it goes. But my view is that as the market comes down to, the other big deal is that this time around rates won't come down, right? At least not the 10-year or the longer end of the curve in a meaningful way. If we get a big enough liquidation in the market next year, and the Fed really starts to crank down interest rates, okay, it won't go to 6, right? It'll go back down to 4, though, in my opinion, while the front of the curve goes down to 2.5, right? As part of stimulus. So the question is, what will the Fed do when they can no longer control the long end of the curve as well? And the answer is massive QE, and that's probably coming. We're still tightening. I think that's going to end very quickly. I think the QT piece is going to be marched out soon in December. I think we're gonna take that off the table quicker than people realize, and that I think we'll be moving to QE very quickly not because of what they say to stimulate for recession or economic reasons. It will be because they are afraid of losing control along end of the curve, and I think that's the only way they can control the long end of the curve for now. Again, my view is that they will not be able to control the long end of the curve if inflation truly does pick up the way I think it's going to pick up again.
Yeah, and that is a worry. I will say no one wants to hear this, and you get a lot of pushback if you're putting warnings out there. We're again just to reinforce time frame, right? This is a longer thing for you to keep your eye on and try to position yourself for, not a short-term thing, but this is a long-term thing. But you have to keep both of them in mind. You can't blindly just pay attention to the short term. But I'm going to end on a short-term note. You are looking at NVIDIA earnings. Is that
Yes.
right? Why is that going to
Yes.
be so important?
So a couple of things that are really important. This is flows, something I haven't talked about. So, if you tuned in for the crumbs, here it is. Vol is getting to a very, very pinned level in the S&P 500. And I believe for probably at least 3 weeks, maybe longer, we are getting real vol compression. The amount of vol supply here in the S&P 500 is dramatic. And so these low vols that you're seeing in the front of the curve, which seem like pretty wild given what we're seeing happen in the market, are likely to persist in the short term in the S&P 500. Now, in the short term, meaning the very next 2-3 weeks, a month of expirations. If you go further out, that vol is too low. And even though the curve is steep, it will continue to steepen in your view, and the front will pin volatility, will pin the market because gamma is available. If that continues to be the case, which I strongly believe it will be, this is now a kind of short-term repeat of kind of the summer of George phenomenon I've talked about, where vol is so well supplied on the S&P, it forces dispersion. And dispersion means certain things are going to start flying around outside of the center. So the S&P itself may not move. Again, look at today. The S&P is literally stuck in mud. That's not a coincidence, right? While certain things are really flying around. We talked about Bitcoin, right? The Russell's up 1.5%. Like that will continue. That reality, that dispersion should continue significantly. Now, knowing that and not knowing necessarily what's going where, right? This is an important dynamic to understand. So we understand the market structure. The S&P is pinned, which forces things away from each other and bigger moves outside the market. The question is, what's likely to be the things that move away from each other, and what direction are they likely to move? And that's a harder thing to be specific on. My guess, based on what we're seeing and based on supply and demand in the Russell in particular, is that the Russell is going to continue to drive higher and higher. You're likely to see significant continued convexity in that area of the market. Anything domestic, anything that benefits from the strength of the US dollar, anything that benefits from a America First policy, right, will continue to push in one direction, which means something has got to go the other way. What's that likely to be? The tech kind of piece of the scenario. I actually am going to go out and say there's a decent probability. Again, this is a pretty wild call if this ends up being right. I want to be clear. It's not a high probability that NVIDIA might actually be topping here. And again, if you look at it, it doesn't look like a top yet. So the fact that I'm saying this is not technical analysis, right? This is not me just kind of, willing something away. This is not fundamentals, by the way. This is because something has to go the other way. And now, again, to be clear, if NVIDIA blows out its earnings, it's way higher than anybody expected, that's off the table. But if they even remotely just come in line or just slightly higher than expected and not really blow the cover off the ball, and you're already starting to see weakness going into it, which kind of weak today, let's see how we go till November 20th. Be careful, because NVIDIA could really start, again, it's not going to crash, But I think that what you start to then see in the charts and what people start to feel into the end of the year is, hey, I don't want to be sticking my neck out on this at this point, especially going into what might be more global conflict next year. We don't know what's going on with China and tariffs. We don't know, yada, yada, right? So that would be something that I would be watching for. What I can tell you for sure, again, not sure about that one. That would be a pretty crazy call if we just called the top as it's happening. But what I feel very confident in is that we're going to get a dramatic rotation, and that dispersion's coming, and the vol in the S&P will continue to be crushed for at least the next 3 weeks, if not a month. It will again push higher. It will continue to grind higher after that. We will get another run into the end of the year. But the trade in the S&P is to buy calendars, to buy long-dated calls, to sell short-dated calls, to benefit from the decaying vol in the front, while still holding out for vol, which will eventually rise in the back end of the curve come early next year, while at the same time playing this rotation again. Lean into what's working right now, and don't be afraid to kind of take convexity in those things, while hedging the things that are starting to actually drag a little bit because they're likely to move away from each other in dramatic ways. So that'd be my advice in the short term.
Brilliantly said, Cem. We're gonna take out a billboard if you get this right, because and we appreciate the fact that you're willing to spitball and just talk out loud and say that. But I think, and again, you have an amazing way of explaining this. But even if it's not NVIDIA, the idea that there has to be a counter for things that are doing well will give everyone the opportunity to look around. If it's not that, it's going to be something else. It sounds like from everything else you're saying, it could be something from Planet Palo Alto. So be careful if you are holding a lot of those names in your portfolio. Maybe just prepare yourself and keep an eye out. And this is why we talk about short term and long term. By the time you want to keep an eye on the long term, because by the time you get around to doing it, if everyone else is doing it, of course you don't have a jump on it. So really important to try to think about these things in what is going to be a period potentially of a lot of change. Love catching up with you. Love
Always
it.
A pleasure. Always a pleasure, man.
So
Thanks
much
for having me.
Thanks. And thanks to everybody. Ralph had a couple of questions. I didn't get a chance to ask him this time, Ralph, because everything was so good. But he wants a book recommendation. I'll email you and you can give it to me off to the side and I'll get back to you, Ralph. Appreciate you guys in the chat. Thanks so much. Cem, have a great one. Boy, we're going to be crazy marching into these holidays, but we'll talk again soon.
Looking forward to it. Take care, man.
All right. Thanks, everybody. Take care and good luck out there.
Bye now.